All right, rocky morning for futures, but we're doing absolutely nothing right now. 30 minutes until the start of the cash trade. I'm Matt Miller.
I'm Sonali Basak. Katie Greifeld is off today, and Bloomberg Open Interest starts right now.
Coming up, a win for 1B3. President Trump's signature tax bill narrowly passes the House after a dramatic all-night session. And words of warning, Jamie Dimon says he cannot rule out the U.S. economy entering a period of stagflation. More from that exclusive interview. And fiber frenzy. AT&T's deal to buy Lumen's consumer business raises the stakes for cable competition. Sonali, what are you watching?
Yeah, and as Matt was talking about, the $5.75 billion AT&T Lumen deal, it will help AT&T reach its goal of putting fiber optic lines in 60 million locations by 2023. You do have shares a little bit soft this morning. Lumen, though, soaring at 2030. I'm sorry, that's when they'll reach those customers. Let's flip up the board here because we do have Lumen CEO joining us in Open Interest later this hour. Of course, Kate Johnson will tell us where she's headed next. Matt.
Yeah, looking forward to that interview, Sonali. Also, snowflakes. New AI products are seeing strong demand, with the firm raising its full-year revenue forecast. You can see those shares up by almost 10% in the pre-market. It's really all about AI for this market. Well, the upside, Sonali, is all about AI, right?
That's where the upside is, maybe. But right now, to the upside, the bond markets, they are sending a warning to the U.S. government about debt sustainability and the potential impact of the tax bill on the deficit. JPMorgan's Jamie Dimon says there are other economic risks to keep in mind as well.
I just think there's a chance that you'll have stagflation. I'm not saying it's going to happen. I don't want the reader to say he's predicting that. I'm not. But we have to be prepared for something like that. I think the global fiscal deficits are inflationary. I think the remilitarization of the world is inflationary. The restructuring of trade is inflationary. And this is not all an American thing.
On Capitol Hill, House Republicans passed a new version of President Trump's massive tax and spending bill that includes a higher limit for SALT deductions and faster cuts to Medicaid. Bloomberg Politics reporter Tyler Kendall is in D.C. with the details. Mike Johnson taking that victory lap, but of course it now heads to Senate.
Yeah, hey, Sonali, a pretty big victory lap from House Speaker Mike Johnson, who got it done by his self-imposed Memorial Day timeline. Now, you mentioned it there. There were some pretty big agreements that came together relatively last minute in order to get this over the finish line. That includes lifting the SALT cap from $10,000 to $40,000. That amount then will get phased down for those making more than $500,000. Both the income threshold as well as the cap will increase by 1 percentage point over the next 10 years. The other side of this was also in a bid to try to appease some of those more fiscal conservative members. They're going to speed up Medicaid work requirements going into effect by December of 2026, moving that up from the originally proposed 2029 timeline. They're also going to speed up the phase out of some of those clean energy tax credits under the IRA. Of course, broadly speaking, Sonali, this bill also extends President Trump's 2017 tax cuts and makes good on some of those campaign promises, such as temporarily eliminating taxes on tips and overtime pay. To be sure, not everybody was happy with this vote at the end of the day, but ultimately it was enough to get it done amid some pretty big pressure from this White House and President Trump.
Yeah, no, absolutely. I mean, a lot of people in my district are going to be angry that the SALT cap remains. Remember, it was uncapped for 104 years before President Trump took that deduction away for the most part in 2017. What about the deficit, Tyler? I mean, Chip Roy can't be very happy because this expands the deficit that the Trump administration was supposed to try and reduce.
Right, exactly. But at the end of the day, it seemed that it was enough to get some of these fiscal hawks like Chip Roy ultimately to vote in favor of this bill. And I will say that our reporting indicates that there was perhaps some last-minute deals between the White House and some of these House Freedom Caucus members to work together on potentially some future initiatives, some future work down the line. That's signaling to us that maybe we could see some sort of executive orders. It was interesting to see President Trump float on Truth Social yesterday, re-up this idea of privatizing Freddie Mac and Fannie Mae, which of course has been in the conversation about potentially helping to reduce the deficit there. So we're going to be watching very closely if some of those provisions end up coming out, if they don't make some significant cuts to the deficit spending when it gets over to the Senate side, because we should say at this moment, if there's concerns about deficit spending with this House bill, the Senate's already raised some concerns when it comes to those savings policies, including those Medicaid work requirements as well as the IRA tax credits.
All right, Tyler, thanks very much. Bloomberg's Tyler Kendall in Washington. Going to be covering this for months. Bond investors are pushing back against President Trump's tax cut plan and deficit blowout. The 30-year yield topped 5% yesterday in a warning sign to lawmakers over that swelling deficit. Bloomberg's chief correspondent for global macro markets, Liz McCormick, joins us now to explain. And Liz, we had also a pretty difficult auction as a result of this plan.
Yeah, I mean, the 20-year bond auction, which, you know, people kind of say is usually not the favored one, so it's a bit wonky, but people are really focused on how demand is for these auctions. So it didn't go well, like Kathy Jones of Schwab said to me yesterday. And so that just kind of ginned up more fears and sent yields higher. You know, these 5% levels are, you know, kind of causing people to take notice. And, you know, like Tyler mentioned in your earlier spot that, yeah, we got through the House and now people are maybe worried what comes out of the Senate could be worse as far as the outlook for debt and deficit. So the story is not over. And like we talked on Monday, Matt, that the Moody's downgrade, maybe it didn't cause a huge reaction, but it brought this more and more to the forefront, the fiscal situation, which bond investors think is troublesome.
At what point does Congress listen to the bond market? Because, of course, this bill did pass the House regardless of what you saw even just yesterday in the longer end of the curve. You see that extending into today and maybe, as you say, potentially into next week, depending on what the Senate does. But at what point does it matter?
Yeah, it was interesting, Sonali. I talked to an investor and said, you know, he said, is the Washington going to care about this? Maybe not. You know, it may take more pain. I don't know. But I believe in our reporting from D.C., there was a few concessions like Tyler laid out. It still leaves, like Andrew Hohenhorst at Citi was saying, it was a little better than he thought in the end. Deficits are still about 6% of GDP for now with this. But the bond market just is saying this is on an unsustainable path. So I don't know, you know, if there's going to be, like some say, a bigger Liz Truss kind of moment where something changes, but people are less than hopeful that the Senate, it'll come out much better. They think it may be worse, like we said. So I think for now, the bond market, this is going to keep, you know, brewing this fiscal issues. And like Jamie Dimon was saying, if we see inflation pick up, you know, those fundamentals will be a problem with people not thinking the Fed can cut until later. So there's just a lot of uncertainty and concern in the bond market, keeping people away from long-term debt.
Bloomberg's Liz McCormick, thank you so much for joining us. Of course, that 10-year hit above 4.6 just yesterday, and we were watching the 30-year look as high as it had been in more than a decade.
I will say the 10-year actually was at 4.6 early this morning. I was at like 3 o'clock this morning, and in the early trade, it jumped up there. We just had Chris Waller on Fox News saying that if the Trump tariffs settle around 10%, then the central bank could cut interest rates in the second half of 2025. And that seems to be what's moving markets right now.
And maybe that'll help out the shorter end of the curve. And maybe that'll help out the consumer. We're going to talk about the consumer because on the corporate front, Nike and Amazon shares are rising in the pre-market. The sports retailer is returning to the e-commerce giant's online store after leaving it in 2019. We're going to unpack the decision with Bloomberg Intelligence senior retail analyst Poonam Goyal joining us now. Who's this a better deal for, Nike or Amazon?
You know, it's actually a good deal for both of them. It obviously adds more appeal to the Amazon marketplace now that you can get such a fabulous brand on the platform. But for Nike, it really opens up distribution in a meaningful way. We know when Nike pulled out of wholesale, it hit them significantly where it opened up doors for competitors. So going back to Amazon, where millions and millions of people shop every day, is going to bring more eyeballs to their brands and really help them win back some of that market share that they lost.
So are we going to see prices on their products, though, rise? Because obviously Nike doesn't make any of its shoes in America.
It doesn't, but it makes its shoes largely in Vietnam. And the current pause tariff on Vietnam is 10%. So we heard that Nike will have some price increases, but they're selective. So they're not raising prices on shoes under $100, which means that the low income consumer who is more strapped for cash isn't going to feel the pinch. When they do increase prices by $5 or $10 on select footwear, I think that's a small amount that the customer who is buying those over $100 shoes could end up willing to pay for. They're not taking up prices on children's, which is also another area where we think, parents would pull back if that was the case. So we think they're doing this strategically, and it shouldn't really curb demand meaningfully or even at all for Nike.
All right, Poonam, thanks very much. Poonam Goyal there of Bloomberg Intelligence talking to us about the Nike-Amazon deal. We'll watch those stocks throughout the day. Some more retail movers, though, on our radar. BJ's maintained its earnings guidance as it expects mild growth throughout the year under current conditions. Investors react positively to that. Ralph Lauren revenue topped estimates, and the polo maker raised its dividend by 10%. Investors like that. And then Urban Outfitters posted net sales that beat estimates, with analysts noting strength in its namesake UO brand. What, 20% the gain on Urban Outfitters?
Pretty incredible, but of the group, it's actually down the most on the year. BJ's is up more than 30% on the year. You would not think, by looking at these numbers, we're sitting in the middle of a trade war. You do see Williams-Sonoma down, though, more than 5% pre-market after reporting.
It's tough for us.
It is tough for us, but maybe they'll lower prices.
Yeah, maybe we'll get some deals there. All right, coming up, Lumen jumps as AT&T buys its consumer fiber business. We're going to give you details on that next. This is Open Interest. Getting out of high interest to look at what's making headlines around the world. BYD sold more electric vehicles in Europe than Tesla for the first time, overtaking the American brand that's long dominated the continent's, well, the global EV market. Sales at China's leading automaker were up 169% from a year earlier. Meanwhile, Tesla's registrations plunged nearly 50%. And Walmart is cutting about 1,500 jobs in its global technology team as it looks to trim costs. A spokeswoman said the changes reflect the company's growth strategies and are not related to tariffs. The downsizing follows a reorganization in February when Walmart cut some jobs and asked employees to relocate to Arkansas and California. The company employs a total of 1.6 million people, making it the largest private employer in the country. And two members of the Israeli embassy staff were killed outside the Capitol Jewish Museum in Washington last night by a gunman who chanted "Free Palestine." That subject is now in custody, and Israel is boosting security around its embassies and staff. The attack was condemned as an anti-Semitic hate crime by officials, including President Trump. The shooting victims had planned on getting engaged next week in Jerusalem, according to the U.S.-Israeli ambassador. Sonali?
We're going to turn back to the AT&T and Lumen deal, Matt, because AT&T is agreeing to a deal to buy Lumen's consumer fiber businesses for nearly $6 billion in cash. It is subject to regulatory approval and is expected to close in the first half of next year. Joining us now, Chris Palmieri. He leads Bloomberg's media and entertainment business here, or the reporting lines here. Chris, you have a significant jump that we saw when we first reported this deal at the end of March. Of course, this was a Bloomberg scoop, now coming to life with the deal announcement. We are seeing some softness in AT&T today. What does AT&T gain ultimately?
Well, if you look at the big picture, we've seen a flurry of deals. We just had Verizon and Frontier, $20 billion. And then another story we broke, Charter and Cox, two of the biggest cable companies merging. So a lot of activity in the telecom space. And the reason is, if you're a big U.S. telecom operator, your business is kind of mature. If you're in wireless or you're in internet access, there's not a lot of new markets to tap. And so it's a big market share battle going on. And that's what's behind here. AT&T is making a big push into fiber, offering higher speed internet access in all kinds of new markets it wasn't in before. And at the same time, the cable guys are offering a lot more wireless phone products. So it's a big market share battle.
How much is this driven by AI? I mean, how much is AT&T trying to position itself to be able to deal with that kind of traffic?
Well, one of the rationale for all this is that everyone feels comfortable that there's going to be a lot more demand for data, in particular high-speed data lines like these fiber optic lines that everyone's buying or building. And that's driven largely by the just enormous data needs of artificial intelligence.
Chris, what about for the other side here? This is for Lumen trying to transform their business. I know that when we speak to Kate Johnson a little later, one big question is why not sell it all? I mean, not the whole of Lumen, but at least they kept the copper part of the business here too.
Well, the business side of this is a little less competitive. I don't want to say it's not competitive, but if you think about the scale you need to compete in the U.S. consumer internet or wireless market, it's just huge. And so from a business standpoint, a lot of these services have still been growing, and they can sell all kinds of additional services to business customers that they really can't with consumer. And so that's the business they want to stay in.
Chris, thanks very much. Chris Palmieri there from our Los Angeles bureau. Keep it here on Bloomberg. Lumen CEO Kate Johnson is going to join us in about 30 minutes to discuss this multi-billion-dollar deal. Coming up next, though, Morgan Stanley's Mike Wilson. Is he still buying the dip in U.S. equities? We'll ask him after the break. This is Open Interest.
Earlier this week, Morgan Stanley's Mike Wilson told investors to buy the dip following Moody's downgrade of U.S. credit. Now, Wall Street appeared to listen. The S&P 500 closed in the green on Monday. Mike Wilson, Morgan Stanley's chief U.S. equity strategist and CIO, joins us now. They bought the dip and they let it go for a few days, really.
If that was a dip, right?
If that was a dip. Define a dip here. What kind of dip would you buy?
I mean, 1% sell-off isn't really a dip worth buying. I would say 5% is a dip, 10% is a correction, 20% is a bear market. That's kind of the way we talk about it. So we do think a 5% correction or dip is possible based on the move in rates. That's kind of been our view. And quite frankly, we're still stuck in that range that we identified earlier this year, 5,500 to 6,100. So we got closer to the upper end of the range. Now we're going to get a dip. I'd be surprised if we take out the 5,500 unless something really, deteriorates again on the tariff side, okay? And we go through that in our mid-year update. Like a lot of things now have turned the corner from a rate of change standpoint. That's going to make it hard to return to a sub 5,500 price in our view.
Is the tariff the only left tail risk? Because it seems that a blown out deficit with this new tax, this one big beautiful bill, is concerning markets, at least when you look at rates, right?
Well, that's right. And that's exactly why we can't break through to the upside, because there's two things going on the rate side. Number one, you have excess supply. The deficit now is a problem again, potentially for the bond market, but also the Fed's on hold, right? The Fed has been a bit, overly focused on inflation, and so you don't have any rate cuts in the near term, and you now have this supply risk and the fiscal deficit blowing out. So that took rates back about 4.5%. That's always been our level where multiples come in. That's a 5% move historically. That's not a 10%, 20% move in isolation. Now, if that leads to something else where we have another growth scare, for example, because rates are higher and all of a sudden recession risk comes back on the table, that's a whole different ballgame. That's not our view.
Okay, so for long end rates, at the very least, at what point do they become a bigger problem for the equity market?
Yeah, I think 5% is where it becomes a real headwind for
10-year.
Yeah, for consumer, everything's priced off the 10-year, right? So then all of a sudden you're looking at, oh my goodness, we have now recession risk potentially is back on the table. But in that instance, just think about it, the Fed will act then, right? I mean, so we have this sort of, it's going to be back and forth like this for the next 3 to 6 months. The way you got to think about the first half of the year, most people came in very bullish. We came in more, not that bullish about the first half because of the sequencing of policy. But that policy now has flipped to a more pro-growth sort of stretch. And that's what the market's going to start to think about. That's why it's going to be really hard to take out 5,500.
That is, by the way, my question of the day, Sonali. At what level do yields really start to put pressure on stocks? And you're saying 5%. Goldman Sachs was out this morning saying 5% as well. Chris Waller was speaking, I think he was on Fox this morning. Are you looking at me funny?
Yeah, I forget exactly where he was as well. I just saw the headlines.
Okay, so, but he was saying, like, if tariffs stay at 10%, the Fed is good to go in terms of cuts in the second half of this year. What are you expecting from the Fed in terms of stimulus? Because that is important to the stock market at the end of the day.
I think it's critical. It's another factor, though, the rate of change is going to turn more positive. Don't forget that, the big rally last fall was driven by, a lot of it was driven by Fed cutting into an economy that was fine. And then they stopped in December. That was really the beginning of the correction that we saw, not tariffs. Okay, so yeah, I think that the Fed will be either communicating that they're turning more dovish, or they'll actually be cutting. Our official House view is no cuts this year, but then they have 7 cuts for next year with no recession.
Yeah.
So that's pretty bullish. So I mean, if we get 7 cuts with no recession next year, stocks are not going down.
A little more on the tax bill here too for a moment here, because as it makes its way to Senate, more fighting, right? I mean, we're not going to necessarily see the same bill clear Senate. We're going to at least
It's true.
see...
Maybe the Senate says no more SALT cap,
What happens from here? How much more uncertainty, and where does that take markets as they hash this out?
There's 2 ways to think about this. So number one, I mean, obviously, I would like to see the deficit cut. I think most Americans would like to see that. That's not happening in the near term. I still hold out hope for DOGE having impact next year and the year beyond. I think there's still initiative there. It's going to take longer. However, from an equity market standpoint, okay, do you want fiscal contraction or do you want fiscal expansion? So as long as rates don't completely blow out and the Fed and Treasury can keep a lid on that, we're kind of back to where we've been the last couple of years. A little aggressive spending that helps growth and rates stay under control. I think the big risk is that it prevents the Fed from actually doing something on cuts or helping out with the balance sheet.
I think that's a really important point, by the way, that we all kind of theoretically, we want the deficit to be reduced. We want government spending to come down because we're fiscal conservatives, right? But from an equity market standpoint,
likes that fiscal sugar.
Of course, and from a growth perspective also, you need that spending. If you start cutting government spending and firing federal employees, it's going to take a toll on growth, it may. Mike Wilson, you're going to stay with us. We are really appreciative that we get you for a couple of blocks here, so he's going to stay with us through the open. That is coming up next. Take a look at futures. We're just about to see the bell ring at the New York Stock Exchange and on the NASDAQ. This is Bloomberg. Moments away from the start of trading, this is Bloomberg Open Interest, and we've got a deal, at least in the House, on one big, beautiful bill. Isn't really moving these equity futures markets at all here. S&P futures down 0.1%, so really no move, even less of a move on NASDAQ futures. Russell 2000. Katie's not here, so I'm not even going to quote the Russell 2000. You hear the bell on the New York Stock Exchange. I would guess it's Hinge Health. I would have guessed Mountain rings the bell today. I think Mark Douglas is down there. I think Ryan Reynolds is down there. Mountain is doing its IPO today, but for some reason, it's a big green company ringing the bell. Down at the NASDAQ market site, there's so many sailors in town, and some of them have walked into the NASDAQ market site as well. So they're ringing the bell there with CSX, America's Navy, 250 years and going strong. In terms of the stocks that we're watching this morning, there are some big movers kind of under the hood. Sonali, come out here.
Sorry, but Hinge Health is going public too, just to say also.
Thank you. I'm just so focused on Mountain.
With Mountain, and he's joining us later in the hour, so we got him first. I want to show you also what's going on with AT&T and Lumen, and it's IPO day. It's also an M&A day. AT&T buying the consumer business, fiber business, for nearly $6 billion of lumens. The deal helps AT&T reach a goal of putting fiber optic lines in 60 million locations by 2030. And Lumen CEO Kate Johnson joins Open Interest later this hour.
That's very cool. So we really have IPOs covered with Mark. He's going to join us later, Mark Douglas. And then M&A covered with Kate Johnson from Lumen is going to join us later as well. We got AI making some moves here because Snowflake is up 11% on new AI products that it says are showing strong demand. The firm raising its full-year revenue forecast. We're also keeping an eye on the AI story that surrounds Apple in a way. OpenAI is buying the AI device startup co-founded by former Apple executive Johnny Ive. He is joining forces with Sam Altman to design some kind of newfangled super magic secret AI hardware. We don't know what it is, but it's interesting. The $6.5 billion deal is the largest in OpenAI's history, and the news sent shares of Apple lower because that's, I guess, competition. Mark Gurman joins us now. He covers all things consumer tech for us. And Mark, this is such a fascinating deal because they're going to come out with like a wand or an orb or some weird newfangled kind of hardware we've never seen before. Not a phone, not glasses. What is it?
Well, they are not saying what it is. I think the first product is going to be a home device. At some point, I expect them to follow up with a mobile device. But these are basically smart products specifically for tapping into ChatGPT. It's basically using ChatGPT as the new interface after the visual operating system. Now it's the speech-based operating system. And so I think this is something that at some point is going to become popular. Immediately, it's not going to jettison the iPhone or the MacBook. But at some point, this is going to become the future and make the future something of that time, of that current era, whenever it becomes popular. Now, you mentioned the Apple shares declining. I want to simplify it a little bit. So Johnny Ive left Apple in 2019, 6 years ago, right? He was the face of the company. He was the face of their hardware. In terms of the top two most important people at Apple, it was him and Tim Cook, and before that, it was him and Steve Jobs. He was known as Jobs' spiritual partner. They worked on everything together. They designed everything together. He leaves. Tim Cook pitches the idea to Wall Street because they were afraid, obviously, of Ive leaving, that Apple and Ive are going to work together. He made it as such that nothing's really going to change. He's just not a formal employee, right? Well, they ended up doing nothing together. And now he's working with the company that many people at Apple believe could ultimately put a pin in the iPhone.
Speaking of that, what replaces what in the future? I want to pull up this take by Josh Wolf, of course, venture capitalist a lot of people keep their eye on. He says that in his opinion, the Mag 7 just becomes MOG, Meta, OpenAI, and Google, which is a very unfortunate thing for stock investors at this current moment because OpenAI is not publicly traded. Mark, I mean, what is the potential here for OpenAI to really take out one of the big guys in the future with the ability to create real devices?
I think it's extremely high, honestly. I mean, Apple has well over 1 billion customers, so this is going to be a slow roll. They're not going to go anywhere in the next few years, but they're playing with fire here. If they don't find a way to catch up in artificial intelligence and make it a real core technology in the company, they're in big trouble. This is equivalent to 15 years ago if Samsung wasn't able to release a device with a touchscreen. AI is as core to the next wave of technology as the touchscreen has been to the last wave of technology. And don't forget, that's what the iPhone was. It was a touchscreen. The iPad, a touchscreen. Lots of computers are touchscreens. That's the equivalent here.
All right, Mark, it's a fantastic story. I recommend everybody reads it. I know I absorbed every single word you wrote and still have a million questions. So thanks very much for that scoop. Mark Gurman there on OpenAI essentially buying Johnny Ive and a whole bunch of former Apple employees. Now, Morgan Stanley is out, as we have been talking about, with its mid-year report and outlook. Strategists reiterated their 6,500 12-month target for the S&P 500, suggesting a better second half of 2025 for markets after the huge shock from Trump's trade strategy. Let's bring back Morgan Stanley's chief U.S. equity strategist and CIO, Mike Wilson. Mike, one of the drivers, I guess, on the upside could be a weaker dollar, right? We've seen the dollar just plummet year to date. I'm looking at the Bloomberg Dollar Index. It comes from 1320 down to 1220, so down 100 points. Does that fuel, you think, better revenues for U.S. companies?
It's definitely part of the storyline. I mean, it's one of the reasons we made this call about 6 weeks ago when the dollar was weaker. We said, you know, U.S. versus rest of the world is about to turn up because it affects revision breadth, which is the #1 driver of stocks. And we see that now in the data very clearly. It really started with Microsoft when they reported earnings. You know, they had a big upside beat, and that was driven, a lot of that was driven by currency, and that drove revisions. And so think about S&P 500. It's multinational companies. They get about 35% of revenues from overseas, and they know how to manage the currency situation. You always hear about currency when it's a headwind. They never talk about when it's a tailwind. But that has driven the revision breadth, and that's what models are picking up now. And if we just stay around these levels, that tailwind will persist into the second half. Our forecast for the dollar, by the way, in this mid-year update is for another 10% decline. So you think about in dollars. So if that continues into next year, okay, that's just going to provide another tailwind for 2026. It's just another reason why the S&P has a really hard time, correcting more than 10%.
Isn't that rough for inflation? I mean, if we're already paying a tariff on all the stuff we buy from overseas, and a lot of the stuff we buy is from overseas, the dollar gets another 10% weaker. It just seems like that drives inflation higher and locks the Fed in place.
It definitely could. And I mean, the one to watch on that is commodities. And so I am encouraged by the fact that oil has been soft. Some of that's
good point.
Due to some of the things.
Jamie Dimon called that out as well.
100%. So commodities are the big thing to watch in that regard. But remember this, Matt. Stocks do well when inflation is accelerating. It's a little known fact, okay? Because it drives earnings. 2020 and 21 is when inflation really took off. Those are the two best years for the average stock. So just don't underestimate kind of like inflation can be bad for the consumer at the margin as long as it doesn't turn into a recession.
But I guess my question about the dollar is why would it drop another 10%? Now, I remember a conversation we had with Jane Fraser about a month ago, or really just a couple weeks ago back at Milken, this idea that the selling of U.S. assets has been a big problem here. Why wouldn't the same be true for stocks if you believe the dollar is going to fall?
Well, it's why it's falling, to your point. So if our call on 175 basis points of rate cuts next year proves to be true, you'll get a 10% decline. If it's only 100 basis points of cuts, it'll be less. But the direction of travel is south for the dollar, particularly against the yen, which they're not going to be cutting rates anytime soon, or against some of even the European currencies, or the currency, but also the pound, because they don't have as much room to cut in a slowdown.
Does Milken feel like years ago by now?
It feels like years. It feels like years ago. You know what also feels like years ago? The last time we saw Nvidia up on the year, right? I mean, I'm sorry, it's crazy. I'm looking at the Magnificent Seven, and I do this every morning with Matt. I keep it on screen.
I like it. I like
7p. I'm waiting for Nvidia to turn positive on the year. It had for a minute, but that minute feels like a year ago.
You use BM7P. I like BM7T, but go on.
Total return. Fine, yes. I could agree with that. But you don't have a lot of the Mag 7 up on the year. In fact, you have pretty significant declines. And I'm wondering from your perspective, you were talking about Microsoft getting that gain from the dollar back, but what about everything else? I mean, at what point does the Mag 7 bring back the market, or are you counting on something else entirely?
Well, the Mag 7 is outperforming again. Even Tesla, I mean, is down a lot on the year, but it's had a really good run here for the last month and a half. And I think this all just comes back to the idea. If you're more uncertain about the future, generally speaking, what do you really want to own? Do you really want to own, in all these international things and things at higher volatility of earnings, or do you want to own the S&P 500, which has the lowest volatility of earnings? You now have a dollar tailwind, and you have an administration that's pushing on the gas pedal now as opposed to the brake pedal, and a Fed that's about to flip. I mean, that seems like a pretty constructive story over the next 6 months, notwithstanding that we have maybe some near-term risks here because we rallied too much in the short term. And now we have a rate issue in the short. I don't think that's going to be a persistent issue. It's a short-term issue.
It's convincing. You're convincing. I feel like I could just spend 10 minutes with you, Mike, and then we don't have to do the rest of the show.
Great. Let's do 10 more.
Mike Wilson there from Morgan Stanley. Great having you on the set. Thanks so much for joining us. Let's get a check on what's moving right now. We are just 10 minutes into, you know what, Sonali, you go.
Yeah,
go
I
ahead
think it's my turn to do this, right? I have no idea. Well, I steal it from Matt while I take over the 9 o'clock. We have Microsoft, as we've been talking about, up on the year and up on the day. We have some love. Remember, when we were before market, before that tax bill passed the House, we did see negative energy in the S&P 500 really turning around a little bit now, but still down more than 0.1%. Alphabet, Nvidia also on the upside today. You do still see Apple down by about 0.6% on a points basis, really dragging down the S&P 500, though others are down as well. Some energy stocks, Exxon, NextEra Energy, which brings us to the sectors. Energy leading the declines by almost the most. You see utilities dragging a little harder, but you do see some green on the screen. That is in communication services. We've been talking about the AT&T deal. Consumer staples as well, higher. This has been a defensive trade, but we have seen it hold up all year. Information technology higher, and of course, those rate-sensitive areas, real estate, financials, taking a hit. Consumer discretionary also taking a hit today, Matt, particularly as we see see those earnings come in, all that positive energy and earnings not coming in to the broader index.
Yeah, for the year, consumer discretionary down 7.5%. And you're right, consumer staples has held up 5.8% year to date. Coming up, AT&T is buying Lumen's consumer fiber business as it looks to expand its broadband services. First on Bloomberg, Kate Johnson, the CEO of Lumen, joins us next. This is Open Interest.
And it's time now for our top calls, some of the analyst action and focus this morning. First up, Urban Outfitters getting raised to a buy at JPMorgan. The upgrade follows the retailer's strong earnings beat across its brands. And next up, it's a different story, though, for Target. The top stock is getting downgraded at Bank of America after the retail giant cut its guidance following a sharp pullback in consumer spending. And finally, Planet Fitness getting raised to a buy at Stifel. The analyst cites the gym chain's improved marketing efforts. He also notes that a Trump bill that's under consideration would allow gym memberships to qualify as health savings account expenses that could drive growth. Planet Fitness up a little bit in the market, Matt.
I could use a couple hours there, probably a week. Maybe I'll join. Switching gears, though, back to one of this morning's top stories. AT&T is buying Lumen's consumer fiber business for almost $6 billion. Joining us here first on Bloomberg to discuss the deal is Kate Johnson, the CEO of Lumen Technologies. Kate, great to have you on the program. We have really had the privilege of talking to you a few times over the past year about this growing business. Tell us just how this deal came about with AT&T and what sealed it.
Good morning, and thanks for having me. Couple things we see. First is AI is becoming mission critical for every enterprise on the planet in order to compete, transform, innovate. And the second kind of major trend is really about consumer. And wireless and fiber demand curves are converging. And you really need scale to compete in the fiber to the home business. So we looked at both of those trends and said, we're going to double down where it makes the most amount of sense, where we have a right to win, where we have proprietary gifts with our physical network and our digital platform to give enterprises exactly what they need.
Kate, why not sell the copper part of the business? You did not sell the whole business. You kept the copper voice lines. And there could be an argument here that that's a part of the business that could otherwise have a drag as consumers disconnect from landline services. Why is it important to you?
That's a great question. So a couple of reasons. The first is that copper business is actually meaningful in terms of financial contribution to the company. And as we take that cash, we now have a choice. Do we want to continue to pay down debt? Do we want to continue to invest in streamlining our operations? Do we want to use it to acquire new capabilities to continue to grow the parts of our business that we know are essential for enterprise? But what's more, those copper assets are in wire centers throughout the country, proximate to almost all businesses. And as we've been talking about, we are innovating in brand new ways, bringing completely new architectures and constructs to the world of telecom. Those assets are essential. They're the secret sauce, actually, for us to provide something called direct fiber access to take advantage of what we're calling the fast lane for AI-powered business. So businesses can go right into our fiber and have direct on-ramps to clouds, bypassing traditional constructs that aren't secure, aren't as fast, aren't as high performing, aren't as intelligent. So critical assets required for our enterprise strategy. I think finally, the copper enterprise customers, they need a place to go. So sure, there's decline in the legacy business. That's not what we're all about. We're all about the customers, and those customers need to go someplace, and we've got a great future for them.
Okay, we've been seeing other deals in the telecom space, Charter and Cox, for example, and I wonder who's next. How many suitors did you have for this asset? Who else is hungry out there?
So it was a competitive deal, and obviously we can't give the details of that process. We're delighted that AT&T was the partner who stepped up. We got a great value for the company, and together with our retained assets, it's a very, very unique deal, but on par in terms of value with the rest of the deals that are happening in the marketplace. I think we'll continue to see consolidation and convergence in that space because we know scale is the game. And AT&T's got scale, they've got a great brand, and they've got a focus on consumer. It's their investment thesis for growth.
One thing that's most impressive, I think, about this deal is that it's a cash deal, right? Yeah, you're not seeing them go out and take more money out for this deal, and it's incredibly helpful for you. Now, my understanding is that about 80% of these proceeds are going to be used to pay down debt. Why not more?
Well, I mean, we're taking the net proceeds after tax and we're using cash on hand and we're paying down about $4.8 billion debt, which is a massive delevering for us. It takes us from, if you're using pro forma adjusted EBITDA, from like 4.9 down to 3.9. That's just the beginning. Remember that cash that's coming off of those other assets is another source for us to continue to delever the company. We're going to find a sweet spot where we're doing the right thing with every single one of those dollars of capital to yield the highest return. This gives us financial freedom and so much flexibility to build a future for enterprises that desperately need it, competing in the AI economy.
Kate, we thank you so much for joining us today. That is Kate Johnson of Lumen Technologies.
I bet you're not the only
she's
person.
She's taking it over. I mean,
she's the new Tim Apple.
Absolutely. Kate, we thank you so much for your time. Now, coming up next hour, we're going to talk to another CEO, Mark Douglas of Mountain, ahead of that company's trading debut. And before we go to break, here's a little more of our exclusive with Jamie Dimon talking about the state of markets and interest rates.
I don't agree we're in a sweet spot, okay? And I think you have to separate two things. The economy has been doing well. All the facts, we have effectively been in a soft landing. And I've already mentioned huge deficits. We haven't finished quantitative tightening yet. There are huge geopolitical issues. There are these inflationary factors out there. And they have to react to all of that. So I think they're doing the right thing to kind of wait and see before they decide.
This is Bloomberg Open Interest. I'm Matt Miller. Quick check on what stocks are doing right now. We're looking at an S&P 500 that's up 0.1%, so not much movement. The NASDAQ doing better, up about 0.5%. So tech stocks helping to drive us a little bit higher right now. If you take a look at NVIDIA, obviously it's one of the heaviest stocks in the world. At $2.5 trillion in market cap, up 0.9%. That makes a difference. Apple is a $3 trillion company, but it's only down 0.6%. Right now, Apple is a fascinating story because of the OpenAI deal. Snowflake, AI driving it higher, almost 9%. BJ's Wholesale Club right now up 0.2%. And I'm so excited, Sonali, because we're going to talk to Stu Leonard himself. In the next hour.
I am a regular shopper there myself. I'm looking forward to hearing what he has to say. Now, I want to bring you some news as well. Kraken is allowing non-U.S. consumers to trade popular stocks like Apple or Tesla as tokens. This is according to the Wall Street Journal. Like Bitcoin, they would trade 24 hours a day. I'll be speaking with the co-CEO of Kraken later this morning in an exclusive interview to talk about tokenization. The big wonder is when it is all going to come to the United States.
Well, you know what? Yesterday, we talked to Mike Novogratz. I'm sure you're jealous. You missed that. You missed out.
It and I had to miss it. Sad about it.
It's awesome to talk to him, but he said he thinks 1 or 2 months. We're going to see stocks tokenized in 1 or 2 months in the U.S.
It's actually a huge fight building under the surface. You have Robinhood, you have Kraken, others, Galaxy. They'd like to.
It doesn't even seem like a fight.
Well, what does NASDAQ?
It's like an agreement. SEC is the SEC is who they have to convince.
Exactly, the SEC. This is accredited investor rules. This is allowing this new form of stock to be sold. NASDAQ and NYSE, I'm telling you, Matt, they're not going to like it.
But very cool though for the kids, right?
Very
That's
cool
how the kids are going to trade stocks in the future. Coming up in the next hour, JPMorgan's Gabriela Santos joins us. We'll ask her what she makes of the ballooning U.S. deficit. Then Mountain's Mark Douglas finally has his IPO today. We're going to talk to him live on this program. And as I mentioned, Stu Leonard Jr. joins the show. This is Open Interest. We are 30 minutes into the trading day. Looking at green arrows here, S&P 500 up at 58.55. And the NASDAQ gaining about 2/3 as NVIDIA gains. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Sonali Basak, and it's interesting, you are still seeing that 10-year, though, hang out close to 4.6%.
WB
it's a day to keep a close eye on that bond market. The 30-year is off the highs. You saw that yield really reach the highest levels in more than a decade on the heels of that tax bill. And speaking of that, dramatic all-night sessions coming up. We're going to talk about how the House passed the President Trump's signature tax bill, sending it now to the Senate, where more uncertainty is expected, Matt.
Yeah, it does look like a slow bleed in terms of blowing out the deficit. It is finally IPO day for Mountain. The ad firm backed by Ryan Reynolds is set to begin the trading today, and friend of the show, the CEO, Mark Douglas, joins us live from the New York Stock Exchange.
Plus, words of warning. JPMorgan CEO Jamie Dimon flagged the risks facing the U.S. economy in a Bloomberg exclusive.
I just think there's a chance that you'll have stagflation. So I'm not saying it's going to happen. I don't want the reader to say he's predicting stagflation. I'm not. But we have to be prepared for something like that. I think the global fiscal deficits are inflationary. I think the remilitarization of the world is inflationary. The restructuring of trade is inflationary. And this is not all an American thing.
Joining us now to talk about this is Gabriela Santos, JPMorgan Asset Management Chief Market Strategist for the Americas. Gabriela, great to have you here on set with us. Thanks for joining us on, Sonali called it tax day. We're getting, I think, incremental movement towards President Trump's
Day.
One big, beautiful bill. This was Johnson's day for sure. What do you make of what we know so far?
So we do think the tariff storm has really calmed down. We just, of course, still need to understand exactly the impact on both the real economic side, the inflation side, earnings. But quickly, the narrative, the market attention has pivoted full on into this reconciliation bill and all of the details of it. And especially, I think the bond market is not falling for some of the accounting fudges in the bill that passed the House, meaning some of the new tax provisions are expiring at the end of 2028, but like we are here talking about extending the 2017 ones. Yeah. That means the Committee for a Responsible Federal Budget estimates this bill would increase, if permanent, the deficit by $3.3 trillion over the window, and so the debt by between $5.5 trillion. That's a lot from an already very high starting point for both. So I don't think it's a surprise that bond volatility will continue.
That's worth saying again, by the way. And, actually, Mike Bloomberg wrote an op-ed about this last week. This administration, this Congress, is going to add another $5.2 trillion to the national debt.
That's right. When we're starting from a point where the debt level was already at the highest since World War II, and we have a non-recessionary economy. So I think if you're a pure stock investor, having some fiscal stimulus later in the year into next year, offsetting some of the tariff headwinds, that can be a good thing. But if you're a bond investor or a currency investor, then you're really fixated on these rising deficit and debt dynamics and the risks for the long end of the curve.
I want to drive home that point with you for a moment here. You saw the 30-year now around 5.1%. We're not at the levels that we saw back in 2007, around 5.4%, but boy, are we getting close. And this is a 3-day chart we're looking at here, how you saw the rise just progress over the course of these discussions. The reason I bring this up is because this bill now goes to Senate. Yep. What does this look like as lawmakers hash this out? As you say, the bond market isn't really buying the accounting gimmicks here.
That's right. And a lot of the conversations we have these days are exactly about what's a normal term premium for the U.S. yield curve these days. And I think it's become extremely clear that it is not the low term premium that we had post-financial crisis up until some of the early days of the pandemic.
Do senators listen? The House is not.
I think it requires a bigger move higher in the 10-year, 30-year yield to really get the attention on Capitol Hill. which suggests that yields can keep drifting higher to try to impose a little bit more fiscal responsibility. So for the 10-year, for example, we're watching 4.8%, which is where we got January of this year. Because if you cross that, then you start wondering, will we go back to 5, which we had hit October 2023, and then you could start to price in risk that goes higher. So for us, a lot of the conversations with investors is, all right, you know, bonds work to hedge recession risk, which is lower, but still there, great. But what about stagflation risk? What about rising term premium risk? And that's where we have to get really creative with the diversifiers.
That 5% 10-year feels like that new danger zone.
Yes. Well, I mean, Goldman Sachs was out in a note this morning saying like 5% is a danger level, and Mike Wilson just told us that as well. There's nuanced points in between here and there that also could be problematic, but we're essentially, you're saying like we have a new normal, Gabby, in terms of tariffs, right? And Chris Waller was just on Fox saying if we settle at 10%, which is about the range that you're talking about, 13 to 15% in your latest research, then the Fed is good to go to make some cuts in the second half of the year. Do you expect that?
No, we think they're firmly wait and see. That tariff rate that we estimate to be at 14% seems to be that equilibrium, but we still don't understand the effects it's going to have on inflation and inflation expectations. This morning, we just got the flash PMI for May, so it improved in a sentiment level, but we also had a surge in manufacturing and services output prices to the highest since 2022. So we're not here to sound the alarms on surging inflation, but for the Fed, the risks are on both sides of the mandate. So just do nothing, I think, is the big mantra, and maybe come back September, December, once we really get a feel for the hard data.
By the way, Serena Tang at Morgan Stanley put out a note the other day saying they expect, their cross asset desk, 7 cuts from the Fed through 2026. And Mike was saying, you know, that could lead to another 10% drop in the dollar. I mean, isn't all of that super inflationary?
I think it completely depends why one would expect there to be 7 cuts. We don't, because we do think recession odds have come down. So it's much more of a slow, gradual reduction in the interest rate. So we think until the end of next year, you could talk about 4, maybe 100 basis points. Then you're already close to 3%, close to neutral. Without a recession, no need to go below that. The dollar is such an interesting point. It's been very correlated to interest rate differentials for years until this year. That relationship has broken down, and the dollar has weakened much more than purely suggested by interest rate differentials. So to us, that signals a great rebalancing is happening by foreign investors. And coming from an oversold position, it implies the dollar still has a ways to go here on the downside.
So this was my question to Mike Wilson, too. If the dollar is dropping 10% in their estimation because of rate cuts, that's one thing. If the dollar is dropping because of foreign sellers, that's a whole other thing. Wouldn't that be very negative for stocks?
I think it depends the magnitude also, because I think we have to remember we came into this year after an extraordinary 2 years, extraordinary 5, 10 years for U.S. markets, especially U.S. equity markets. So foreign investors have a very big overweight to U.S. assets. And it's not that we see in the flows them selling U.S. equities. It's more that marginal dollar is being put to work somewhere else, European equities, Japanese markets. So it's more of a gradual depreciation of the dollar. And if absorbed by willing domestic investors, it doesn't have to be doom and gloom for U.S. equities. But it does mean for U.S. investors that it is worth having foreign currencies as a diversifier.
What do you think about Mark McCormick was on surveillance the other day. Remember, we were watching from TD.
He was quite fired up.
He was, but I thought it was really interesting that he was saying, like, deglobalization has really driven foreign investors to say, look, we have other places to put our money. Not that the dollar is no longer the world reserve currency, but they're pulling it out of U.S. assets, a number of different U.S. assets. What do you think about that theme, deglobalization, maybe being a headwind for equities, U.S. equities, for example?
Yeah, for us, we've been incorporating that in our long-term forecast, really since the first trade war in 2018. This idea of a multipolar world, of supply chain decisions that are purely cost-based, something that increases inflation uncertainty, and that leads to this idea of a higher term premium on the curve. I think for currencies, in our view, it's much more of this idea of rebalancing portfolios. And what I think was the catalyst, two things. On policy was April, when U.S. equities nearly got to a bear market, and the dollar sold off 4%. So to a foreign investor, that benefit of hedging with the dollar just didn't work anymore, so they're no longer having as much unhedged positions. Number two, the sell-off in the Mag 7, right? That was a lot of the reasons for that huge overweight to U.S. equities, and maybe that story has kind of run out, and it's time for European equities to shine, Japanese equities to shine as well.
Well, I'm glad you brought that up, because I want to pull up the S&P 500, what it looked like over the past month alone, because you have seen, after kind of a sour attitude all year, investors start to take on risk again. Technology stocks, communication services, discretionary stocks, even some of that Mag 7 getting some of that bid back.
Great timing for this chart, a 1-month chart,
right?
Yeah, exactly.
It's topping out, is
That's
what
cherry
I'm saying.
picking.
The reason
Cherry
I chose
picking
a month,
that.
well, it's because we had Mike Wilson sitting here saying people are buying NVIDIA again. I mean, NVIDIA's it's barely outperforming, right? I mean, when you look at the broader
what
index.
about since late December? The Mag 7 is still down 15%.
That was my
versus
point,
their
too.
Thank you, Chanel. So, look, those are, as a group, they're extremely profitable companies. The AI theme is real. They're making money from it, but everyone knows that already, owns it. Expectations are high. So a little bit of a floor when we had the first quarter earnings season. We got some pretty good earnings beats. But I don't know that a lot of investors have conviction that the group will be responsible for 70, 80% of U.S. equity returns again.
Here, this is my worry, Matt, that what we saw in that chart might be the best it's going to get for a while.
Yeah, no, I think a lot of people may, sure. If you bought like a week after, if you bought when President Trump said, now's a good time to buy stocks, right? What was that, April 9th? You're in the money for sure. Gabby, great having you on the show.
Thank
really
you so
love
much.
having you here. Gabriela Santos of JPMorgan Asset Management. Still ahead on this program, we're going to speak with Mark Douglas, the CEO of Mountain, ahead of that company's trading debut on the New York Stock Exchange. This is Open Interest. Let's get to high interest now. We'll look at what's making headlines around the world. Iran is warning it'll take action against Israel and hold the U.S. legally responsible if the Israelis act on reported plans to attack Iran's nuclear facilities. The Iranian foreign minister is urging the UN to take effective measures against those threats. The missive follows a report by CNN that Israel is preparing a possible attack on Iran's nuclear sites. Shares of Fannie Mae and Freddie Mac are soaring after President Trump said that he was giving very serious consideration to bringing those firms public after more than a decade of being under government oversight. Trump's allies and other Republicans see privatization of the mortgage giants as a way to reduce the country's deficit and return money to taxpayers. And the crypto exchange Kraken reportedly plans to allow non-U.S. customers to trade Apple, Tesla, Nvidia, and other popular stocks as tokens, digital, like crypto tokens over a digital ledger. Galaxy Digital CEO Mike Novogratz joined Open Interest yesterday to talk about the uptake of these tokenized equities.
I think you're going to see tokenized equities, at least experiments with them in the next, 1 to 2 months. I'm just throwing out a range. I don't know for certain, but it's going to happen. And tokenization itself, I keep saying this is going to go real slow and then all of a sudden real fast. And I think, quite frankly, it might end up driving a lot of crypto adoption. People will be more comfortable owning Apple stock in a tokenized form, maybe, than owning a crypto.
That was a very cool interview. And by the way, Sonali is going to speak with the co-CEO of Kraken in the next hour on Bloomberg Technology, so stay tuned for that.
Coming up, we're going to take a look at how the Trump tariffs are making a difference at the grocery store. Stu Leonard Jr., Stu Leonard's president and CEO, is joining us next. This is Bloomberg Open Interest. Let's get a check on these markets because we have been looking at a turnaround story. We were, before the market, lower than the tax bill passed the House, and we saw a return to life in the S&P 500 up to about 0.1%, but really a defensive trade out there.
I feel like it was Waller because, listen, if you look at the futures, like Joe, if you pull up ESA index, GIP, you'll see that we dropped after the tax bill, and then when Waller said the Fed could cut, we came right back up.
Well, anyways, people want those lower rates, but that tax bill isn't getting it for them. We're going to switch gears, and we are going to talk about how all of this impacts the consumer, because grocery stores across the country are having to wrestle with the impact of President Trump's tariffs. Stu Leonard Jr., the CEO of Connecticut-based supermarket Stu Leonard's, says his local farmers are jumping with joy right now, and he joins us now to explain. Stu, good to see you. I grew up going to Stu Leonard's myself. Looking forward
Hey, also, I
going there
noticed
again.
you got your MBA from NYU, right?
Yeah, you too?
Yeah, my daughter.
Oh,
my
very
daughter
nice.
just
Very
was
nice to
here.
hear it. Tell us a little bit about what's going on, because, of course, a lot of Americans have been struggling under the weight of inflation for so long. There are a lot of concerns about how the tariff pressure would impact not just consumers, but also farmers. What are yours saying?
Well, first of all, we're boots on the ground right here. We have 100,000 customers a week coming through Stu Leonard's every week. So we're listening, talking. And basically right now, everybody feels pretty calm. There's this big looming threat out there of the tariffs, and you can hear that with Walmart talking about it. So far, we haven't felt any tariffs hitting Stu Leonard, except on the wine and liquor side, pretty much, okay? And the reason I say that is a couple of them. First of all, we don't have any tariffs on fresh products between Canada right now. We're getting major things from Canada. I brought one of these babies for you. How do you like this thing right here, okay? That's salmon right there, okay? Last year we were $9.99 on salmon. We're $8.99. Check it off, price went down. Another thing that prices have gone down on, and everybody, this was a major thing here, is all these eggs. Okay, a dozen eggs were $10 a dozen last year. They're $4 right now. You're seeing
$4. Stu, what kind of chickens are those? Because I buy eggs at Stu Leonard's all the time. I like them to be pasture raised, so they have 108 square feet of room to roam, and they are not $4 a dozen.
How much are they?
I would say $7.49.
Okay, all right. Well, I'll check on that. It's maybe I got the wrong number there. Okay, but anyway, I don't think egg prices have gone up right now. They've gone down compared to where they were 2 or 3 months ago. It's
a fair point. By the way, I think I hear the avocado girls behind you, which puts me in a better mood. Always good to hear singing avocados. Stu, your point is that you get like 80% of your groceries from local farmers, right? That's why people go to your stores. Are the farmers happy though? Are they able to sell all of their goods? Because there were reports that they weren't.
Matt, but basically what we're doing is we're splitting the tariffs with all of our importers and farmers right now. That's the deal, sort of. We're doing our own little dealing here with them. We don't want to put any small people out of business. We're being very flexible. We want to sell their products. But, you know, one of the things that's happening, and we're seeing it happen a little with wine, rather than pay 10% more for wine or liquor that's coming over, and we have about 30-day cushion because everybody brought it in stateside. But just lobster tails, for instance, okay? These are down $1. Why is that? We were exporting 80 million pounds a year to China of lobster. Sometimes we even had a hard time getting them. This year, that is down, so we're seeing a lower price in lobsters right now this Memorial Day, which is great. So salmon's down, lobster's down. Hey, a couple things that are up, like we have to make guacamole with our avocados. They haven't changed in price, but the labor to make fresh guacamole in the stores every day bumped that cost up a dollar per container. Other than that, I think consumers could feel good for Memorial Day this year.
Yeah, speaking of long weekend, everyone is about to go out shopping, maybe in bulk if they're having people over. I mean, ultimately, even past the holiday, even past the middle of the year, what worries you most, Stu, about the direction of the consumer, about the direction of the goods that you're taking in? Because realistically, everything around the tariffs is not over yet.
Well, I think the thing that worries me the most is, look, we definitely have on the forecast out there a little bit is prices going up. I mean, as Walmart indicated also. I worry about that. I'm trying so hard to keep prices down. You know, whether eggs are it's $3.99 or $7.99, whatever. There's conventional, pasture raised, all different ones. You know what? I don't want to go up over. You know, if they're $7.99, I don't want to go to $8.39. Sales go down. So, you know, we're trying to monitor that right now at the store. Price increases keep me up at night. And also, I'm splitting a lot of this with our vendors. I mean, it has an impact on our margins, which are already razor thin. So,
right,
keeping our prices down, but also handling all these price increases and keeping, you know, our margins, you know, solid. We have 3,000 people we have to take care of here.
Stu, great having you on, especially for locals. Stu Leonard really is a treasure. I'll be at the Yonkers store for sure this weekend. Stu Leonard Jr.
Hey,
there.
Matt.
Yeah?
Tomorrow, if you're going to be at Yonkers at 2 o'clock, Walt Frazier and Earl of Pearl Monroe are going to be at Stu Leonard's in Yonkers at 2 o'clock.
I will check it out. Stu, thanks so much for joining us. From Stu Leonard's, this is Bloomberg. Advertising company Mountain and some of its shareholders have raised $187 million in an IPO priced at the top of its range. Shares of the company, which counts Ryan Reynolds as its chief creative officer, are set to begin trading today. So joining us now live from the floor of the New York Stock Exchange is the CEO of Mountain, friend of this show, Mark Douglas. Mark, great to have you on. Congratulations on the IPO. I've been asking you about this for 3 years, and normally you're not allowed to say anything about it. Now you could finally talk about it. How difficult was the road to this IPO with all of the market volatility thrown at you at the beginning of this year?
Yeah, it was. First off, thanks. I appreciate the congratulations. It wasn't easy. We filed our S1 on February 28th, and the market proceeded to, you know, kind of crash a bit right following that, but the company's doing really well. We grew 47% year over year. When we published the S1 on February 28th, those numbers weren't published. So we finished the quarter, published the growth. Our goal is to provide consistent growth for both for our customers as well as for the market. And so we've, you know, the window opened up in the last week and a half. And we jumped right in. You know, we started the roadshow on Wednesday, and here we are today, the following Thursday.
Mark, talk to us more about conversations with investors. You brought in BlackRock, for example, but what about everybody else? What were they looking for from you as you took the company public?
Yeah, I mean, the number one question we got on the roadshow was size of the market, which is huge. I mean, we're talking about bringing performance marketing to small and mid-sized businesses, e-commerce companies, local brands. And you know, there's over 1 million of those in the U.S. that we think could easily be on our platform. So there's this really big market, and then we got to ask a lot about competitive moat. And we're approaching half the company is engineering. So you combine those two, you know, this huge focus on engineering, big total available market, lots of growth, adjusted EBITDA last year, 39 million and growing. And investors responded. I think we were something like 14 times oversubscribed for the IPO. So we were very pleased with the response we got.
Mark, I saw somewhere on social media, I saw Ryan Reynolds doing a little spot for the IPO as well, saying like, I got involved in this company and you can too at the IPO. People are always asking what he actually does for Mountain. Tell us about his role.
Yeah, I mean, he has, you can think of it as 2 or 3 roles. So first and foremost, think of Ryan and George Dewey as co-creator and another 5 people. They are essentially Mountain's kind of brand team. They contribute hugely to the brand. You know, the phrase, the hardest working software in television, which is what we want to do for our customers. I mean, that's right out of Ryan and George and that team. How we position those things. We have a huge also performance marketing team that they contribute in terms of making small, mid-sized customers. Ryan is also, I mean, he does sales calls. He's always available. I mean, he has an incredible work ethic, and he really, really just knows how to resonate with consumers. So it's been an incredible partnership working with him.
So speaking of Ryan Reynolds, my understanding is that his creative agency was transferred over to its original owner, so not in this public company listing, but you have a new contract with Maximum Effort, that creative agency, to keep up the relationship. What does that look like, and what kind of value do they add to you?
Yeah, so the form of the, could think of it as the legal form of the relationship change. They are focused entirely on creativity, so it didn't make a ton of sense to have like some of the world's most creative people also now be subject to SEC filings and stuff like that. So the form of the partnership changed, but how we work together has not changed at all. I mean, that team is here with me right now, here on the floor, and like you cannot tell within the company that anything has changed, and that's the way everyone wanted it to be. So it's been absolutely incredible. And the original owner, by the way, is Ryan. There's no other parties involved. We have an incredible partnership between, Mountain, me, him, Maximum Effort, and we continue to plan. That's going to continue. It's been working incredibly well.
Mark, you are, we go to you all the time for what's happening in Silicon Valley, what's going on in social media, what's happening in connected advertising. And you're on the West Coast normally, but you grew up here, right? Across the street from Yankee Stadium. The Yankees are first place in the AL. The Knicks, although they had a really tough loss last night, are outperforming everybody's expectation. How psyched are you about New York sports right now?
Well, I'm hesitant to make a comment on the Yankees because I was kind of a Mets fan growing up. Don't hate me for saying that. I couldn't afford to get a Yankees game back then, so the Mets were so bad you could pretty much just walk in. But anyway, I was just going to sound like a cliche. I love New York. I truly do. I grew up here. Grew up every street in New York. I came to New York Stock Exchange as a kid when there was no security and you could just walk back in and be here. Now it's been incredible. And I support the Yankees and definitely the Knicks. I've seen a lot of good games. Knicks Piston, man, that's a throwback. That's that's like history repeating itself.
Well, that's kind of what I was leading up to, Mark. I mean, the New York Stock Exchange has such a rich history. We take it for granted because this is financial news, but what does it mean to you, a kid who grew up in New York City, to be listing his company on the New York Stock Exchange? Yeah, I mean, this place was literally part of my playground. I was here, Central Park, Rockefeller Center, and it made me who I am. And then to come here and now list a company on the New York Stock Exchange and talk to the president of the New York Stock Exchange and all the companies that preceded me, more than 100 years of history. Honestly, and let me add, and have people here that I truly love. It's an amazing experience. It's an amazing time. I'm very happy to do it.
Mark, thank you so much for joining us. Don't even want to talk about the Knicks today, but we will save that for another time. That is Mountain CEO Mark Douglas. Let's get a check on these markets, shall we? Because we are watching a turnaround story start to fall apart. We are looking at an S&P 500 now about flat on the morning, Matt. We were looking at gains of almost 0.2%. The Nasdaq 100, though, still holding up, almost 0.5% higher, and that 10-year hovering around 4.6%. That tax bill, of course, making its way through the House and on to the Senate. Looking forward to watching that bond market next week as we watch those talks play out. Yeah, I mean, we're still up 17.2% from the April lows, but it does look like a turnaround kind of falling apart. I hope that's not a jinx on the Knicks. When I walked in this morning at 3 o'clock, one of the security guards was actually crying. He was literally tears falling from his face because they were up like 13
points with a few minutes to go and then lost in overtime.
Catatonic was the New York Times words for the stadium yesterday. So just absolutely brutal. But
it's only game one.
It's only game one.
And let's talk a little bit more about stocks then, away from basketball. Bloomberg cross-asset reporter Isabel Lee is here on set with us. I'm not sure if she cares about basketball, but we're starting to see the market slide back. What are you looking at? Individual stocks.
Under the hood, we're seeing some green. So Snowflake is higher by around 10%. That's the highest since February 2024. So they gave a strong outlook for quarterly sales after launching a slew of products over the past year. So product revenue, which makes a bulk of the company's business, will increase about 25%. So that's higher than analyst estimates. The company also raised its full-year forecast for product revenue. So Evercore said that bump, coming despite an uncertain economic environment, illustrates management's confidence in the durability of demand. So Snowflake makes software to really ingest and analyze data from a variety of sources. That's as much as I can explain simplistically. And I don't care about basketball.
Do you care about clothes, though? Because a stock that I'm going to, you know what?
She won't talk about shoes with us.
I'm so
No shoe
disappointed.
talk with
I'm
Isabel.
going to change your mind about this. But in the meantime, clothes, Urban Outfitters at its highest levels ever.
Highest levels, yes, it's jumped as much as 24%. Now it pared back some of those gains, but still it popped 20%. So the company reported net sales that beat average estimates. So Urban Outfitters has a portfolio of companies, including Urban Outfitters, Anthropologie, they have nice mugs and nice clothes, Free People, FP Movement, and etc. So analysts note that the strength of Urban Outfitters, the namesake brand, is positive and that the retail's margin expansion is looking good. So JPMorgan said for the first time in 3 years, first quarter same-store sales grew, and Bloomberg Intelligence said that this firm could lift its forecast for operating margin for the rest of the year with minimal effects from tariffs. So really, lots of good positive reviews. But there's an Urban Outfitters near my home, and most of the time when I walk past by it, it doesn't really have a lot of people. But
It's
I
empty,
guess,
right?
What?
They seem empty.
People
Whenever
buy
I see
things
them,
online.
But maybe just mine, and maybe people order online too.
Also, maybe it's the time that because I'm going at 1 o'clock in the afternoon. I was just looking at Bitcoin. Right now, 110,800. This is an all-time high. This is an all-time high.
Yes.
Shanali, is this an all-time high for Bitcoin?
Sounds like an all-time high to me.
So crypto stocks must be up.
Yes, crypto stocks are up, no surprise. Galaxy, Riot, Maras, and Marathon. So all of them are really just riding on the sentiment of crypto. There's a wave of optimism. We have this key advancement in the key stablecoin bill. We have MicroStrategy, or strategy just now, just keep on buying stuff. And really, we have just
MicroStrategy changed its name to simply Strategy.
It's
simple
the future,
and cool.
I suppose.
And yet they don't have a strategy, right? It's just they own Bitcoin.
Maybe they have, we just don't know it.
Right. Fair enough.
And you had Mike Galaxy Novogratz here yesterday, and he also commented on.
Can I tell you something? Mike Novogratz, I gave him such a hard time years ago for when Bitcoin dumped off the train. But you know what? He's riding high, and he's finally listed. It took him years to get into U.S. listing, and Galaxy now is actually listed on U.S. exchanges as of last Friday.
Yeah.
And they're up 30% year to date, aka last Friday. But still.
Yeah, well, he's doing well in a number of different respects.
The Goldman of Bitcoin is what he wants to do. Let's see if he makes it there.
Isabel Lee, thank you so much for joining us. Isabel Lee from our cross-asset team. By the way, Sonali, you're going to talk to
Arjun Sethi. It'll be a really interesting conversation. That is the co-CEO of Kraken next hour on Bloomberg Technology. He's also a VC investor, so has been in a lot of those high flyers. Think XAI, for example. And now you're going to see Apple, Tesla among the companies that will be tokenized for non-U.S. investors. Let's see if they bring it here to the United States. Coming up next, we're going to go back to normal way finance. Jamie Dimon backs the Fed. The JPMorgan CEO spoke exclusively to Bloomberg about the uncertain path ahead for the U.S. economy. We're going to bring you some of that conversation next. This is Open Interest. We're looking at a day of IPOs here, Hinge, Health, and Mountain, and Hinge in particular. You're looking at them indicated to open at $34 to $36 per share. That would be a pop. They IPO'd at $32 a share. Remember, it's been a choppy trade in the market this morning, but we have seen a lot of love for these new IPOs after a dearth of them. Now, switching back to the big story of the day, in the world's biggest bond market, investors have been pushing back against President Trump's tax cut plan. Bloomberg Haslinda Amin spoke with JPMorgan CEO Jamie Dimon in an exclusive interview at the bank's Global China Summit in Shanghai.
You talk about that kind of complacency. I'm talking about the asset price in the United States, and it's a long list of things. It's QE, it's fiscal deficits, it's global fiscal deficits, it's potential the trade wars, it's these huge complex geopolitical situation, and I look at all of those probably not being properly priced into the marketplace. But we don't know what's going to happen. So, I saw last night's reaction. I don't worry about one day move in bond markets. So.
You don't worry about one day, but when you take a look at yields, they are at higher levels than they were before Liberation Day. I mean, we talked about how 30's higher, and some are talking about 10's getting to 5's, 30's getting to 7%. How are you assessing that? I mean, how high do yields have to go before they reach breaking point?
Yeah. I don't know the answer to that. No, we assess, the way we run the company is we prepare for a full range of outcomes, regardless of what you think. I just think there's a chance that you'll have stagflation. So I'm not saying it's going to happen. I don't want the reader to say he's predicting stagflation. I'm not. But we have to be prepared for something like that. I think the global fiscal deficits are inflationary. I think the remilitarization of the world is inflationary. The restructuring of trade is inflationary. And this is not all an American thing. And the infrastructure needs are inflationary. And now you have offsets. You have oil prices down there quite a bit, which is quite deflationary. But with all those things taking place, yeah, you may be surprised.
As we said, it is a higher yield environment, and you have said before that we could see some sort of rebellion in markets around the world. Is that still a possibility? How might that look like? Yeah,
so I would not call it a high yield environment. I mean, if you look at economic history, rates have been far higher than this, and they surprise people over time. And like I said, I think a lot of the longer term trends have inflationary attributes to them. And so the other thing for your person on TV, credit spreads are low. So you can have two things go against you, which is credit spreads gap out and rates are going up. And so we'll see how it plays out. So I don't want to guess how it plays out. I'm on the cautious side. I'm a little skeptical that we're going to have kind of just an ongoing soft landing here.
I'd be remiss not to ask you about the Fed. Given the higher yield environment, which you say it's not, but it is still higher than what it was before.
Would it go higher?
Will it go higher? And also, will it force the Fed's hand?
Yes. I mean, there's always a notion that somehow the Fed is omnipotent and can do whatever it wants. And they do set short-term rates, but they also have to follow the facts. So they raised rates because inflation went up, and they can't control. Even today, trillions of dollars of these bonds are sold every day. That's done by investors around the world. They cannot control all of that. Foreigners own $35 trillion of U.S. financial tradable assets. And so, they have to react to reality, in which and that's not a criticism, they say they're data dependent, but they have to wait and see exactly what happens and then do the appropriate thing.
But the thing is, their reality is different from the reality you have in mind. If you take a look at what Neil Kashkari said, he said the U.S. economy is on solid footing. And some other Fed officials have said that in terms of Fed policy, it is in a very sweet spot. So their reality is quite different.
I think, I don't agree we're in a sweet spot, okay? And I think you have to separate two things. The economy has been doing well. All the facts, we have effectively been in a soft landing. That does not tell you what the future is going to be.
That was the CEO of JPMorgan, obviously, Jamie Dimon, speaking with Bloomberg's Haslinda Amin in an exclusive interview. Now, over to Washington, where this morning the House passed a new version of President Trump's massive tax and spending bill. It includes a cap. It still includes a cap for state and local tax deductions. If you were waiting for that to sunset for the last 8 years, you will currently be disappointed. Joining us now is co-host of Balance of Power, Kayleigh Lines. So, Kayleigh, it looks like the SALT caucus, I guess, capitulated is the right way to put it.
Well, they certainly agreed to vote for this package on the House floor, which, of course, passed very narrowly, 215 to 214 votes. So the tightest of margins. And they were able to secure a SALT cap that is 4 times what it is currently, which, of course, was $10,000. But yes, they weren't able to get everything they want. Frankly, no one was able to do that, though compromises were made in order to make sure that this got across the floor. Not only lifting the SALT cap to appease moderates in blue states, but also making some concessions to harder line conservatives who are worried about the fiscal implications of this legislation, which is expected to raise the deficit by trillions of dollars. They were able to secure from the speaker promises to bring forward stricter work requirements for Medicaid to 2026 from 2029, also accelerate the pace of a rollback of clean energy subsidies from the Inflation Reduction Act. And President Trump is certainly happy about the end product here. He is praising it on True Social, but a word of warning to everyone here in Washington, on Wall Street and beyond, is that this thing is by no means done yet. And what just passed the House is very unlikely to be the final law, because it goes to the Senate next, and the Senate is very likely to change a lot of this legislation, including potentially the price tag of it, as the Senate would like to see many of the tax cuts made permanent rather than just for a short period of time when it comes to things like no tax on tips or overtime pay, which is only in this legislation expected to last 4 years. The Senate may want to extend that timeline, and they are not taking kindly, at least a lot of Republican senators even aren't taking kindly to some of these Medicaid restrictions that have been put into place, as well as the clean energy rollbacks I just mentioned. So the Senate is going to be the next big hurdle here, and they could send something very different back to the House, and it could be a lot harder to pass that changed version.
Yeah, fascinating. It looks like they're about $1 trillion and change apart. The Ways and Means Committee Chair Jason Smith telling reporters that they're at $5.25 trillion, while the House is under 4 when they're looking at those cuts here. Now, how do you think this is going to change in the Senate, and how will the House receive that?
Well, the price tag could be a big component of it, keeping in mind that the Senate is using a bit of a different mathematical calculation here as it considers the implications this legislation will have for the deficit, using what's called the current policy baseline, which essentially assumes because the 2017 tax cuts are current law, extending them won't be counted as deficit additive, even though that isn't actually the case if we look at the actual number of the U.S. debt deficit and how that is likely to change. But that's how they're looking at it mathematically, which gives them a little bit more wiggle room than the House had in terms of tax cut extensions. The other unique element to the U.S. Senate that is not present in the House is the Senate parliamentarian, which essentially is going to be what dictates whether or not all of this is actually fitting for budget reconciliation legislation, which by definition has to pertain to the budget and kind of the balance sheet of the United States, if you will, either be tax and revenue focused or spending focused. And there are some elements of this tax package that might not meet that threshold for approval from the parliamentarian. That could take some parts of this bill out of the picture. And then, of course, there's the Medicaid concern. Senator Josh Hawley, a Republican populist, has been very vocal about not wanting to see any cuts to Medicaid. He could cause some problems. There are senators from states that have benefited from an influx of money from the Inflation Reduction Act and those clean energy subsidies who do not want to see that unwound so quickly. And there's still some in the Senate, some fiscal hawks like Senator Ron Johnson, who think ultimately that spending cuts don't go deep enough and will be advocating for more of those. So there are many different ways in which we could see this thing change when the Senate returns in the first week of June.
All right, Kayleigh, thanks very much for your coverage. Kayleigh Lines is the co-anchor of Balance of Power out of Washington, D.C. You can watch that every day at 1 p.m. and then the late edition at 5. I want to make a clarification, by the way. Yesterday, I was speaking with Citadel's Angel Ubide, and I referred to him as an advisor to Spain's prime minister. I want to make clear that he's not a current advisor to Spain's prime minister. He's a former advisor to Sanchez, the prime minister of Spain. And I want to say that correctly because I want to have him come back on.
Yeah,
he was a great guest.
Sure will. And he can speak globally, and global markets right now are really where it's at.
All right. That's it. That's the end of the program, right? That's the end. This is the end. Okay. Yes. This is Bloomberg.